And when you purchase a home, the money comes from somewhere, right? When you close on your home, the closing attorney gets money from the mortgage bank. The mortgage bank wires money, and then the closing attorney uses that money to pay off the seller and to pay off any existing liens on that property. So where does this money come from if you're taking a mortgage with you? Are they issuing another round of debt? They haven't been paid back on the current mortgage yet. So where does the money even come from? Which sort of builds into this whole thing. If you can take the interest rate with you, how do you get more money at that old interest rate? I don't know if people have really thought it through in that much detail. Another problem for investors is when you're 5 years into a mortgage, you have started chipping away at that amortization schedule. An amortization schedule is how mortgage debt is paid back. At the beginning, it is heavily interest. And over time, you pay a little bit more in principal and a little bit less in interest. This is to protect the investor. You pay a lot up front so that if you refinance, you sell your home, or you pay off your mortgage, the mortgage bank doesn't, or the investor doesn't completely lose their shirt. 5 years into a mortgage, especially if it was a mortgage that was originated during COVID and had a super low interest rate, you are not paying very much in interest. So if there's a new round of money being wired to purchase a new home, and that investor is stepping into that old amortization schedule, they're not getting very much interest off that. And I don't know if they will have the appetite to do that portable mortgage. The final problem, as I see it, is you have to think about who this is addressed at. Like I said earlier, this is addressed at people who would otherwise be upgrading homes. Not that they can't, but they don't want to because their current housing payment is just too affordable. So imagine a person purchased a home, let's say in 2018, and paid about $350,000 for it. The balance on that mortgage is anywhere, depending on the down payment, let's just say it's around $300,000. Now, if they're moving and upgrading, they're not going to buy a $350,000 home because that $350,000 home in 2018 is probably worth $650,000 now. They're not going to buy the same home. They're going to upgrade. So if their current home is now worth $650,000, they're probably going to be buying around $850,000 or $900,000. But the balance on their current mortgage is $300,000 or less. Where do they get the rest of the money from? Would they have to make a massive down payment to retain that ultra low interest rate from their current mortgage? Would they have to get a second mortgage to bridge the gap? Again, these are things that I don't think the proponents of this portable mortgage have really thought through.